that's what this is. I get to do this podcast with you,
Mm-hmm.
right?
Are you saying we're friends?
Today, yes.
Yeah.
But hi, Meg.
Good morning.
Welcome to another week of Real Personal Finance. I thought today we could chat about this little elephant and donkey in the room.
Yes, tiny.
The election season is upon us, and
we're
no
already
doubt,
exhausted.
Right. I mean, but it's been. Someone said it the other day, and I don't know who to attribute the quote to, but it was essentially some weeks can feel like decades, and some decades can happen in a week. Something I just totally chopped it up, basically meaning that history can have nothing happen for a long time, and then in a few weeks you could have all this history happen in one time. And in the last few weeks, we've had an attempted assassination on a candidate for the presidency, which is insane. Then we had a call for unity across the country, which was, looked like was happening until that candidate went past the 25-minute mark in a speech and then went to a stump speech, which was very much so not about unity.
Yes.
And then we had the other candidate drop out, and potentially their vice president will become the nominee. And we don't know that yet, but my goodness, a lot of change and uncertainty in the political sphere. And it's probably going to get more contentious in the coming weeks and months. And a lot of people start to worry about, well, what can I do for myself? And what are the ramifications going to be of what side wins, who controls the presidency, who controls Congress? How's that going to affect me? And so I thought it'd be great to chat about that today.
Yes. And just to make clear from the beginning, because you and I were talking about other directions such a conversation would go, this very much is related to our personal finances as opposed to our fears for the future of democracy in our country,
right?
Which is probably a bit beyond the scope of this podcast.
Yes, and beyond our expertise.
Yes, exactly.
Like I did not major in political science or law, so we'll have to leave that to others. Mm-hmm. But it's not an uncommon thing anytime an election's happening for us to think, well, there's clearly going to be a direct consequence to the outcome of this election and what happens in the economy, what happens in the stock market, and really what happens with my personal finances, right? It's a question that we see, and I think it's going to be asked a lot with what looks to be perhaps one of the most contentious,
elections.
Elections for the presidency that we've perhaps ever seen. But I want you to know that this is a common question every election cycle.
Every time.
Then maybe the magnitude feels a little dialed up here, but the fact that it's happening is not dialed up at all. It's always a question.
Yeah. And just going back to the last episode, we recorded this issue of recency bias.
Yeah.
Things that are happening now or just happened always seem more important and more likely than things that happened 4, 8, 12 years in the past.
Absolutely. And so one of the things I thought we could just look at is I brought a couple of charts. So we'll just briefly explain what they are, but they're just going to show what's actually happened for long-term investors over the course, the recorded history that we have of the presidency and the markets. What you can see on the screen in front of us, we have this chart. And the chart is essentially saying, hey, the markets have been invested since 1926. We can track the data. And we're just looking at the Standard & Poor's 500. So that's the 500 largest companies in the US. Mm-hmm. And it's just asking what's happened to markets during different presidencies, whether they're Republican or Democrat. And Meg, what do you largely see it showing?
I believe that is up and to the right, as they say.
Right. Yeah.
Pretty consistently, except for poor W. That seems to be, other than Calvin Coolidge and Hoover, he seems to have the only presidency during which the S&P 500 did not go up in total.
Exactly. Yeah. Coolidge was maybe flat because he had the roaring 20s and
Yeah.
into the Depression, and Hoover was definitely down, sadly.
Yeah.
Everyone else, whether you have a Republican in office or a Democrat in office, the Standard and Poor's 500 continued its climb. And that really points back to the idea that capitalism works and a president only has limited controls over what happens in the economy, right? Like even the Fed, so even who's in charge of raising interest rates and lowering interest rates, the president can't tell them what to do. They have their own board of governors that makes their own choices about what to do with the economy. He can decide who to appoint to that to be in charge of that, but he doesn't get to tell them what to do. The same thing happens with the Department of Justice, right? Like the attorney general decides what cases to bring and not bring. He doesn't work for the president, and the president gets to tell him who to bring cases against. Right? It's the same idea. There's these powers that are carried out by the government, but the president himself does not hold those powers. Right? And you can see that here. Capitalism works. People wake up every day and try to go better themselves and make a profitable business. And by doing so, people make money.
Yeah, and to piggyback on that idea that the president doesn't directly control the economy, there is also the aspect that the markets are not the same as the economy.
100%.
They can perform in very different ways. So if you're making market like investment decision, even if you had perfect information about the future economy, that would not give you perfect information about the future markets.
Oh, so true. And even if you have perfect information about the markets, usually you're going to mess that up too. And we can just see that by looking at active investors and how often can they beat markets. And it's about 2% of the time, which is basically insignificant. Yeah. Okay. And then let's shift this though to, okay, that's cool, Scott and Meg, that the president can't control it. But you know who's in charge of the purse strings of the economy? Congress. So what about Congress? And so what we've done here is I've just flipped the chart now to saying, okay, let's look at Congress. So the same S&P 500, and we're asking who's in charge of the chambers of Congress. So the House of Representatives and the Senate. And if they control both, this chart has one color, so red in the 1920s, right? And then blue for quite a much larger period of time than I realized, not having been have studied much of U.S. Congressional history. I missed that class. The Dems were in power largely from the 1930s until the end of the early 1990s, with little brief stints in the 1940s and a mix of the two in the late 70s, early 80s. But again, I mean, you tell me if you see it any differently, but I basically see up and to the right once again.
Yep, me too.
Yeah. So who's in charge of Congress has little to do with what are the rates of return going to be in the stock market.
I will say, at least historically. Yeah.
But in all actuality, I think what we can do when you think about, that's a good thing to say historically. Yes, that's true. But also let's just pull back a second and ask what drives markets, right? What drives markets is essentially looking at supply and demand of goods and services across economies. And of course, interest rates in the banking system can have something to do with it. And there's many other drivers, policies, of these types of regulations. You would often say the more regulation there is, the harder it is to compete. That should bring things down, vice versa. But when we look at things overall, you can see that no one driver like Congress is going to dictate all of the rate of return of the stock market, right?
Yes.
There's no one system that controls it all, that you can just turn that valve on and off. It's not that simple. And I think part of the thing is that one of the issues we run into as humans is we want it to be simple. We want to know, like, okay, if this party goes into power, markets go down. If this party goes into power, markets go up. Okay, now I have something I can run with. But what we just showed is that that's sadly not the case.
Right. And more broadly, I think we've covered this before on this podcast. We crave certainty as humans. We really do. All of us, you and me included. And unfortunately, we cannot have it. We can look at data and get sort of probabilities, historical trends, etc., but we can't know what's going to unfold going forward. And that's what's behind all of this anxiety and, unable to sleep at night and worry.
Yeah. And, so we just showed you some facts, which is basically like the outcome of the election is not going to control the movement of the stock market on its own. But that probably doesn't make people feel warm and fuzzy.
Right. Facts, data, logic, unfortunately, don't actually shape our behavior all that much. It's all about our emotions.
So given that, if you're worried about what's coming for the election and what should I do, rather than just trying to make a choice of, I should do this or do that based on this outcome, I think what Meg and I would say you should do, or Meg could speak for herself, but I think what we should do is just go revisit your own plan.
Isn't that always the answer, though? Do you have a question about fill in the blank? What does your plan say? And why did you create that plan in the first place?
Right. So, and by saying revisit your plan, ideally you don't jump straight to a tactic of this is my current investment allocation. Should I change it based on what's about to happen with this election? Right. Yeah. Instead, come back to what is the plan that you have, as Meg pointed out? What are the core values and the main goals that you have for that plan? Have any of those changed? Has anything shifted?
Right. When I just to sort of share what I would do if I were reviewing my own plan, I have a statement of financial purpose, which is time spent under the trees and making a memory with my 2 daughters every day. That's the North Star of my financial plan. That is impervious to politics.
Right.
That it's like orthogonal, has nothing to do with politics. And then we can break that sort of more sort of vision, mission oriented statement down into specific goals about, like vacations I want to do or colleges I want to send them to. But really starting with that almost philosophical level of what's all this work for? Right.
But that, to me, that's the key, right? Is if we don't understand that first, and if you can't, the thing I love about it, if you have a really good statement of financial purpose, like for me, it's essentially time in the ocean, time with my family, and doing fun, like building fun stuff with my friends. Basically, that's my core purpose. Like that's what this is. I get to do this podcast with you, right?
Are you saying we're friends
today? Yes. But once you have that as your main lens to look through, you want to be pushing back anything that's tactical or strategic that you want to be changing your plan should be able to flow through that lens, and it should make sense.
Yeah. I mean, I think your use of the word lens is that's a concept I use also. Every decision you have to make, look at it through the lens of, does this help me spend time under the trees and make a memory with my daughters every day?
Right.
And if it doesn't, well, maybe it's, sometimes it's just the reality of living in modern life, like having to deal with health insurance paperwork doesn't directly help me do those things, but I've got to do it. Yeah. But yeah, I think it is it's constantly bringing you back to what am I doing this work for? Why am I living my life? What's the purpose? Yeah.
Exactly. And once you have that, then you're going to obviously have, well, what are the main goals we're trying to hit based upon this? And then once we have the main goals, then we want to ask, well, what philosophies or what evidence do we have to apply to those goals to help us achieve them as quickly as possible? And I think one of the things we'll come back to then, if we're looking at, say, investments, we're going to come back to, okay, I know I want to retire at such a time and I want to have this amount of risk and return in my portfolio. Then you're going to come back to, well, should I make a change based on what's happening in the election? And Well, the factual answer is going to be no, you shouldn't, because the outcome of the election is not going to dictate the pace of change of the market from what we can see, right? So that won't make sense. But then you can also ask yourself the question, are there other things I could be doing to make myself feel better about all of this?
Right. And that comes down to, I don't know, probably the core of all aspects of our life, which is, what can I control and what can't I? And what's the serenity prayer that you learn in AA? God grant me the knowing serenity. The difference between serenity to what I can control, what I can't, and the wisdom to tell the difference between them. I totally butchered that. But you can't control the markets, and you can't control the outcome of the presidential election or the congressional election. You can't control most of the things in this world. There's actually a fairly short list of things you can control,
right?
Which in a way is kind of nice, because then at least you can control them all.
Right. But I think what you can come back to is you can look at your own plan and go, what are the things that I can have control over that'll make me feel better? So like if it was, let's say a client who is retired and we have a specific asset allocation to help them get growth in great years and protect against down years. That's basically a stock and a bond allocation, right? Coming in and saying, I want to be more conservative right now because I'm worried about the outcome of this election. That probably will hurt that client far more than it will help them. Because essentially what they're trying to do is they're trying to market time. They don't realize that's what they're trying to do, but they're trying to make themselves feel safer. So I think another question would be, well, what else can you do in your plan to help you feel safer?
Yeah.
Could you choose to save a little bit of the distributions that are coming to build up a little extra money in your savings account for when you need it, right?
Yeah. Or if you're
an accumulator, right? If you're building assets, could you be setting more aside so that you have them there? For people who are in the accumulation phase of life, where we're still saving more and more and more, I actually think putting money off to the side to save right now is lovely, because eventually, now we just had a bear market, 2022, but another one will eventually come. And when bear markets happen, they happen for two reasons. They happen because the risk and return, the return is derived by the risk we take. If the risk wasn't there and those downturns didn't exist, you'd be getting what's called a risk-free rate, which would be the US Treasury, right? The reason we get the higher returns because we're willing to take the risk and ride the roller coaster down. But if you're able to save a little bit extra cash right now, when that downturn happens, then it's like having the Amazon Prime sale in the stock market at that moment, which is awesome.
I've got issues with Amazon Prime, but I won't bring it up this time.
Okay, Nordstrom's half annual sale. Pick your sale.
There we go. Yeah. And I think, that's sort of getting to the idea of keeping some powder dry, which is a common sort of idiom in the investing world. And for me, it's not even about that. It's just when we talk about investing and we choose this asset allocation, which is to say this balance of stocks and bonds, one of the inputs that goes into choosing the proper balance of stocks and bonds is what's going to allow you to sleep at night. Because if you are staying up at night worried about your investment portfolio, it's probably invested too aggressively, right? And for me, building up more of a cash cushion is all about that. Well, maybe you're fine with not touching your investment portfolio, but having a bigger cash cushion, instead of 3 months of living expenses, it's 6 months or even 12 months. I have a lot of clients with a year's worth of living expenses. It's simply going to help you sleep at night, because it just gives you that much longer time frame of, okay, I'm trying to think of some way of saying this that didn't involve a curse word. If things go poorly, all of my idioms have curse words in them, either in the election or for any other reason, you've got an entire year to figure out your response to it.
Right.
And so that longer time frame, I find, is very comforting for people, because if and when the bad thing happens, they've got time to respond. They won't immediately be in a bad place.
Totally. Yeah. It all comes back to resilience planning and becoming comfortable being uncomfortable with uncertainty, which is, sad. It's not a sad thing, but it's the reality. We want certainty. We crave certainty, but life very, very rarely gives certainty.
Yeah.
right?
And one of the ways that I often frame financial planning is that it's a combination of managing risks and planning for opportunities.
Mm-hmm.
And right now, we're very heavily focused on sort of the managing risks because people see this huge potential risk looming in the next 6 months or so.
Right.
And so cash is always like your best friend in risky, uncertain, volatile times.
Yep.
But as you were mentioning earlier before we were recording, are there other parts of your financial plan that are focused on targeting risks that you haven't actually done yet because life is lifing for you? Have you not created or updated your estate plan to make sure, that your loved ones are taken care of if something happens to you? Have you not gotten the proper proper insurance, life, disability, auto, homeowners, umbrella liability, whatever those things are? I betcha if you do all the work to make your financial situation as sort of robust and resilient as you can with all those things we've just listed, I bet you will care at least a little less about the outcome of the presidential election, at least as far as your personal finances go.
Agreed. The last thing I would probably say to all of this is, and it's not actually finance related, but oftentimes there's this uncertainty, this feeling, it's this need for action to feel control. Mm-hmm. And so one thing is, if you look at all of your finances and they're all good and you still feel that need, then you might want to think about, well, what else can I be doing to help with whatever this thing is that I'm worried about? So if you're worried about the election, what can you do to help contribute to your party or to your person to help them have a better outcome? We're here in California. I already know what state, who the electoral votes are going to, right? But if you want to go have some outcome in the election, regardless of what party you're with, there's states that you can probably help do things with, whether it's go and canvass or it's donate money or it's get involved, whatever that is. Like, you figure out what it is, but there's probably something that has to do with the inaction that has us feeling this way rather than taking action. And that's really where I just would end with on my thoughts for the day. Is it's really all about looking at, do I have a good plan in place? Have I taken the right actions? And if I have, how do I still feel? And if I still want to feel like I need to take action, well, then it's probably outside of your finances. So what can I do outside of that?
Yes, please make it outside of your finances. Dear God, stop mucking around in your finances.
Yeah, because portfolios are like a bar of soap. The more you handle them, the less you have. It's the way it works. All right. Well, great. Thanks for chatting. And we'll see you guys next time.
All right. Bye-bye.